Bull market. A bull market is when prices in a financial market are trending upwards, and when there is a 20% rise in a major stock market index. There's an overall positive optimistic market sentiment, which leads to more buying than selling, and results in an overall rise and appreciation of assets. Bear market. A bear market is when prices in a financial market are trending downwards, and when there is a 20% decline in a major stock market index. There is an overall negative market sentiment or fear in the market, which leads to more selling than buying and results in an overall decline and depreciation of assets. Long position. A long position is when you buy a stock, also known as going long, expecting price to move upwards and making a profit based on its appreciation. For example, you buy a stock for $5 and it appreciates to $10. You've now made a profit of $5. Short position. A short position is when you sell a stock, also known as going short, expecting price to move downwards and making a profit based on its depreciation. For example, you want to short one share of XYZ stock that is trading at $10 a share. So you need to borrow one share of XYZ stock from your broker, and then you sell it on the open market and pocket $10 from its sale. You now owe your broker one share of XYZ stock. At a later date, XYZ's stock drops from $10 a share to $5 a share. You buy back one share of XYZ stock for $5 and give it back to your broker. You've now made $5 from this short trade, as you previously sold one share for $10, but it only costed you $5 to buy it back and settle your debt with your broker. Short interest is the total number of shares of a stock that have been sold short and that haven't been covered yet. An increase in short interest signals investors are getting more bearish. A decrease in short interest signals investors are getting more bullish. Short squeeze. When a stock rises significantly due to heavy buying presence, short sellers who are holding short positions on that same stock are forced to cover those shorts and purchase the stock in order to limit further losses. The double action of long buyers buying up the stock and short sellers also buying up the stock triggers an explosive move upwards. Swing trading. Swing trading is holding positions for more than one day. These positions are often bought and sold within a few days, up to a few weeks. Day trading. Day trading is buying and selling assets within the same trading day and session. These positions can last minutes to hours, but all positions are liquidated before the end of the trading day and session. Technical analysis. Technical analysis is looking at past price movement and market data, identifying patterns and trends, and using it all to help make predictions of future price movement and future market direction. Ticker symbol. A ticker symbol is a unique abbreviation used to identify a publicly traded company on a stock exchange. This is usually what you type into your trading app to find the company you want to buy or sell shares in. Apple's ticker symbol is AAPL. Microsoft's ticker symbol is MSFT. Amazon's ticker symbol is AMZN. Stock exchange. Stock exchanges are marketplaces where traders, stockbrokers, and corporations buy and sell securities. In North America, you have the big ones, such as the New York Stock Exchange, the NASDAQ Stock Exchange, and the Toronto Stock Exchange. In China, you have the Shanghai Stock Exchange. In Europe, you have the Euronext. Brokerage. Brokerages are companies that act as the middlemen in connecting buyers and sellers in order to actually complete transactions of stocks and other financial instruments. These are the apps you have on your phone or computer that you use to actually buy and sell stocks. Think companies like TD Ameritrade, Charles Schwab, and Robinhood. Margin. Margin is you borrowing money from your brokerage in order to purchase stocks through offering up securities and assets you already have in your account as collateral. Margin allows you to buy more than you otherwise could with just the cash you have in your account, meaning you can use margin to take on larger positions and achieve larger returns. But this also opens you up to possible larger losses and potentially unlimited risk. Level 2 data. Level 2 data is an exchange's electronic order book that retail traders and institutions can access in order to get an in-depth look at all the bid and ask prices of a particular asset, as well as volume. This allows you to essentially see supply and demand in real time and can be used to better time trade entries and exits. Volatility. Volatility is the swinging of a stock price up and down. When you see smaller and less frequent swings of price, this signals lower volatility. When you see larger and more frequent swings of price, this signals higher volatility. Liquidity. Liquidity is how fast and easily you can buy or sell an asset without it significantly impacting the stock price. Higher liquidity means once you click buy or sell, your position will be filled very fast, almost instantly at times. Low liquidity means when you click buy or sell, your position won't be filled instantly, will often take a longer time to be filled, and might not even be filled at all. Trading hours. Trading hours are the hours that the main markets are open and when you can actually buy and sell stocks and other financial assets easily due to high trading volume and high liquidity. North American stock markets, such as the New York Stock Exchange and the Nasdaq Stock Exchange and the Toronto Stock Exchange, operate from 9:30 a.m. to 4 p.m. Eastern Time. The stock market is closed on weekends and on holidays. Pre-market trading and after-hours trading. Pre-market trading is the trading activity that occurs before the regular market session opens. For North American exchanges, pre-market trading is from 4 a.m. to 9:30 a.m. Eastern Time. Traders look at the pre-market to gauge market strength and direction for the coming trading session. After-hours trading is the trading activity that occurs after the regular market session closes. For North American exchanges, after-hours is from 4 p.m. to 8 p.m. Eastern Time. During pre-market and after hours, there is lower liquidity, larger quote spreads, and higher price volatility. Companies often choose to announce earnings outside of regular trading hours because this way, investors are not able to take immediate, irrational action against the stock and gives investors an opportunity to actually digest the info and act more rationally once the regular market session opens. Market order. A market order is an order to buy or sell a stock at as close to the current market price as possible. For example, if the stock price is currently trading at $5 and you want to buy a share, you simply click buy without any additional requirements. And if you are trading a highly liquid and popular stock, it'll often fill instantly and very close to the $5 price. Limit order. A limit order is a buy or sell order at a specific price where the market currently is not. Let's say the price of a stock is trading at $5 and you don't want to purchase it until it reaches $4. You would set a buy limit order for $4. And if price gets there, a buy order for $4 would be automatically triggered for that price or lower. If price never gets to the $4 price, no buy order would be initiated. So let's say you are now holding a stock you purchased at $4 a share and you don't want to sell until it gets to $10. You would set a sell limit order for $10. And if price gets there, a sell order for $10 would be automatically triggered for that price or higher. If price never gets to the $10 price, no sell order would be initiated. Stop order. A stop order is used to limit losses or to lock in gains. Let's say you're currently holding a stock you purchased at $10 and don't want to hold it any longer if it dips below $8. You set a stop order for $8, and if price reaches the $8 price, a sell order will be automatically initiated to cut your losses. Let's say you purchased a stock at $20 and the current market price is $30, meaning you have gained $10. You want to lock in those gains, so you set a stop order for $25. If price starts to reverse and hits that $25 price, a sell order will be automatically initiated so that you cash out of your position and lock in your $5 gain. Bid-ask spread. A bid price is the highest amount a buyer is willing to pay for a stock. The ask price is the lowest amount the seller is willing to accept for a stock. The difference between the bid and ask price is called the spread. Price gaps. A gap up is when price opens higher than the previous day's close. A gap down is when price opens lower than the previous day's close. A gap fill is when price returns to the pre-gap price. Price gaps often occur due to news releases outside of regular trading hours that cause swings in price. Market cap. Market capitalization is the total value of a company's shares. Simply take a company's number of outstanding shares and multiply it by the current market price per share to get your market capitalization. EPS, or earnings per share. Earnings per share is calculated by taking a company's net income, subtract from that preferred dividends, then divide that amount by the average number of outstanding shares. EPS is used to gauge how much money a company makes for each one of its shares of stock. In simplified terms, investors use EPS to measure a company's profitability. PE ratio, or price to earnings ratio. To calculate a company's PE ratio, you take a company's current price per share and divide it by the earnings per share, or EPS. PE ratio is a method used to gauge whether the price of a stock is accurately or fairly priced against its earnings potential. Traditionally speaking, the higher the PE ratio, the more overvalued the company is, where in contrast, the lower the PE ratio, the more undervalued the company is. Risk-reward ratio. The risk-reward ratio allows you to measure what you can possibly gain for every dollar you risk on an investment. What you risk should at minimum be equal to what you can gain, meaning a risk-reward ratio of 1-to-1. In the best cases, your reward potential should be higher than what you are risking, meaning a risk-reward ratio of 1-to-2 or 1-to-3, because this allows you to risk less to gain more, which gives you an edge in the market. Before we continue, we want to hear from you. Tell us in the comments below right now what video topics we should cover next. As always, please hit the like button, as it allows for our team to continue to produce more free videos on YouTube. Earnings report. Earnings reports are quarterly financial statements issued by publicly traded companies that investors use to gauge company health, performance, and whether they are good investments or not. Earnings reports include an income statement, a balance sheet, and a cash flow statement. Before each earnings report, there's an estimated EPS, and when the earnings report is actually released, the final EPS will either meet, beat, or miss the estimated EPS, which can lead to higher volatility and swings of price. An EPS meet will traditionally mean the stock will stay stable. An EPS miss will traditionally lead to a dip or depreciation of the stock. And an EPS beat will traditionally lead to a rise or appreciation of the stock. Dividend. Dividends are periodic payments made to you from companies you own stocks in, usually taken from the company's profits. Not all stocks pay dividends. When looking at dividend-paying stocks, identify the dividend per share, dividend yield, and dividend payout ratio. Companies that provide consistent dividend payments that also increase over time are seen as companies that are healthy and gaining in strength. Companies that provide inconsistent dividend payments or dividend payments that decrease over time are seen as weakening companies. IPO, or initial public offering. An IPO is when a private company goes public and starts selling its shares on a stock exchange where the general public can purchase. There are always IPOs to look out for, one of which was the sleeper stock Monster Beverage. And if you had invested $10,000 during its IPO, that investment would now be worth over $10 million. Stock split. A stock split is when a company splits its stock, which increases the number of shares outstanding, but as a result, each individual share is devalued. For example, if there is a 2-for-1 split, every share you have is now doubled, but each one of those shares is worth half as much. This is often done to make each share price lower to appeal to new investors so that they'll buy in. Stock buyback. A stock buyback is when a company uses its cash to repurchase its own outstanding shares in order to reduce the number of shares on the market. This in turn means the remaining shares on the market increase in value and theoretically should lead to an increase in the company's stock price. Warren Buffett famously loaded up on Apple stock due to his support of their aggressive share buyback program, which has resulted in the meteoric rise of Apple's stock ever since, and is Berkshire Hathaway's largest stockholding. Blue chip stocks. Blue chip stocks are stocks from large corporations that are seen as safe, stable, and reputable, and that have often been around for a longer period of time. They have many years of solid earnings and often pay dividends. Think companies like Microsoft, Apple, Johnson & Johnson, and Coca-Cola. Penny stocks. Penny stocks are stocks from small companies with a share price that is less than $5. They have lower trading volume and lower liquidity. When you try to buy or sell a penny stock, it will often take longer for your positions to be filled, and they might not even be filled at all due to low volume and low liquidity. OTC or over-the-counter securities. OTC securities are securities not listed on major stock exchanges and require a broker-dealer network to buy and sell them. These companies don't qualify or meet standards to be able to trade on major stock exchanges. Over-the-counter securities tend to be less liquid and are also less regulated, which brings more potential risks. S&P 500. The S&P 500, or the Standard & Poor's 500, is a market capitalization weighted index that tracks the performance of 500 of the largest companies listed on US stock exchanges. This index was launched in 1957 by credit rating agency Standard & Poor's. The S&P 500 is often used to gauge market sentiment of the US stock market as a whole, meaning you can look at its performance to give you a bullish bias, bearish bias, or neutral bias. Dow Jones Industrial Average. Dow Jones is a stock market index that tracks 30 large blue chip stocks from the New York Stock Exchange and NASDAQ. The index was created by Charles Dow in 1896 to act as a proxy for the health of the wider US economy. Dow Jones Industrial Average, again, can be used to gauge overall market sentiment and performance of the US stock market. NASDAQ Composite. NASDAQ Composite is another stock market index that includes all the stocks listed on the NASDAQ stock exchange. Just like the S&P 500 and the Dow Jones Industrial Average, you can use the NASDAQ Composite to gauge overall market sentiment and performance of the US stock market. VIX, or CBOE Volatility Index. The VIX, also known as the Fear Index, measures the implied volatility of the S&P 500 and the market's expected volatility over the coming 30 days. The VIX has a negative correlation or inverse relationship to the S&P 500. Meaning when you see the VIX rise, this signals fear is rising and market confidence is declining, which often results in the overall stock market to trend downwards. If the VIX falls, this signals fear is declining and market confidence is increasing, which often results in the overall stock market to trend upwards. Knowing this, you can use the VIX as a way to gauge market sentiment and your trading directional bias. ETF, or Exchange Traded Fund. An ETF is an investment fund that invests in a basket of stocks, bonds, or other financial assets, meaning when you buy an ETF, you are investing in many different securities all at once, allowing you to be more diversified. ETFs are bought and sold on traditional stock exchanges, meaning you can buy and sell them just like any other stock. There are ETFs for every industry and niche you can think of, meaning you can buy ETFs for specific sectors you want to gain exposure to. Everything from tech ETFs to currency ETFs to AI ETFs to banking ETFs to energy ETFs. Inverse ETF, or Inverse Exchange Traded Fund. Investing in an inverse ETF allows you to profit from the decline of a benchmark index, such as the S&P 500, instead of shorting individual stocks. In simplified terms, if you see the S&P 500 go down by 2%, you should see the price of your inverse ETF go up by 2%. Mutual fund. A mutual fund is a type of investment where money is pooled together from various investors to then invest in stocks, bonds, and other financial assets. Mutual funds are managed by professional money managers, which comes with its own set of fees. Money from a mutual fund is earned in 3 ways. 1. Through dividends from stocks or interest from bonds held within the fund's portfolio. 2. Securities that are sold for a profit. 3. If the fund's shares increase in value, you can sell your shares in the mutual fund for a profit. Index fund. An index fund is a type of mutual fund or exchange-traded fund that is constructed in a way to match and track market indexes, such as the S&P 500. The baseline goal of an index fund is to replicate the performance of the underlying market index it is mimicking. REIT, or Real Estate Investment Trust. REITs are companies that own and operate income-producing real estate, such as hotels, shopping malls, office buildings, resorts, apartments, self-storage facilities, warehouses, and commercial forests. Investing in REITs gives you exposure into real estate investments without having to buy real estate assets directly. Bonds. Bonds are a type of security issued by governments and corporations when they are looking to raise money. When you buy a bond, you're essentially giving a loan to the issuer, and they have an obligation to pay you back the face value of the loan on a specific date, known as bond maturity. You get interest payments typically twice a year, up until you are paid back the face value of the bond. Bonds differ from stocks because you don't own anything. They just act as an income stream. Capital gains. Capital gains is the tax you have to pay after selling an asset or investment, such as a stock or bond, for a profit. Interest rates and the Fed. When the Federal Reserve is trying to cool down the economy, they will raise interest rates, which in theory should cause the stock market to go down because money and borrowing is more expensive. When the Federal Reserve wants to stimulate the economy, they will cut interest rates, which in theory should cause the stock market to go up because money and borrowing is cheaper. This means the stock market and interest rates have a negative or inverse correlation. Recession. A recession is traditionally defined as 2 consecutive quarters of negative GDP. During recessions, stocks tend to trend downwards due to negative market sentiment. Recessions do also present great buying opportunities because if you look back at many of the previous recessions, they are often followed by some massive bull runs afterwards. This means investors can take advantage of recessions and buy great companies at a heavy discount. Options trading. Options are financial instruments or contracts that give the buyer the right to buy or sell an asset at a set price at any time, up until the contract expires. The buyer is not obligated but has the option to do so. A call option gives you the right to buy a stock at a set price. So if that contract has a strike price of $100 and the stock increases to $150, the option contract allows you to still buy the stock for $100, which is below the current $150 market price. A put option gives you the right to sell a stock at a set price. If that contract has a strike price of $50 and the stock decreases to $25, the options contract allows you to still sell the stock for $50, which is above the current $25 market price. Futures trading. Futures are a lot like options, except the contract actually obligates you to buy or sell the asset for a set price on a set future date. Futures contracts are used to speculate on the future price movement of an asset or to hedge risks. Commodities. Commodities are natural materials such as metals, gold, corn, oil, and flour that humans process and use for the economy. Hard commodities are natural resources extracted or mined from the earth, such as copper, natural gas, oil, and gold. Soft commodities are grown and harvested, such as lumber, wheat, coffee, and cattle. Commodities are often traded through futures contracts, but you can also invest into stocks of companies that produce commodities, or invest into ETFs and mutual funds that have commodity exposure. Forex, or foreign exchange trading. Forex trading is the act of trading international currencies. The Forex market, or foreign exchange market, is one of the most widely traded markets in the world, with daily trading volume of over $6 trillion. Unlike the stock market, the Forex market is open 24 hours a day, from 5 p.m. Sunday to 5 p.m. Friday, Eastern Time. Currency pairs. Currencies are quoted as pairs, meaning it is the value of one currency against another currency. For example, if you see a price quote of euro-dollar being 1.0882, this translates to 1 euro gets you 1.0882 of US dollars. There is an invisible one beside the currency on the left of the currency pair, also known as the base currency. If you see a price quote of pound-dollar being 1.2617, this translates to 1 pound gets you 1.2617 of US dollars. PIP. In foreign exchange, a PIP stands for percentage in point, which represents a unit of change in an exchange rate of a currency pair. Major currencies are priced to 4 decimal places, and a PIP is 0.0001. For pairs with the yen as the counter currency, a PIP would be 0.01. Cryptocurrency. Cryptocurrency is digital currency that doesn't require banks or financial institutions to verify transactions. You can purchase cryptocurrency as an investment or use it for online transactions and to buy things. Cryptocurrency is supported by blockchain technology, which is a public digital ledger that records transactions across many computers, and that data cannot be altered. Dead cat bounce. When a stock is on the decline, in a downtrend, and in a bearish market, you might notice a pullback or slight upwards bounce and recovery before continuing downwards. This is known as a dead cat bounce. Dark pools. Dark pools are private exchanges and forums used by large institutional investors to buy and sell large block orders, and allows them to hide and mask their moves from the general public to avoid impacting the larger market. Dark pools are perfectly legal and regulated by the SEC. Compound interest. Compound interest is when you earn interest on the principal money you have, but then going forward, also earning interest on the new interest payments you received. For example, if you have $100 and earn 5% interest per month, after 1 month, you'll have $105. Then the next month, you'll earn 5% interest on $105, which means you'll have $110.25 after month 2. This is compound interest in motion, as you earned 5% interest on your initial $100 and then another 5% interest on the $5 interest payment you received from the previous month. Over time, this creates a compounding, snowballing effect where your money grows exponentially.